Today marks 10 years, and one day, since the enactment of the most significant and controversial financial services regulation of modern history, the Dodd-Frank Act, which was passed in response to the 2007-2008 financial crisis. In light of that anniversary, and considering the current economic climate, what better opportunity to assess the impacts of Dodd-Frank, the good, the bad, and the ugly. So starting with the good, this year's stress tests, a requirement of Dodd-Frank, show that banks are better capitalized than ever and don't represent the same systemic risk they once did. This is largely due to the enhanced capital requirements of Dodd-Frank, but significant credit also belongs with the banks themselves. Turning now to the bad. Many of the features that make Dodd-Frank unique have had significant difficulty in operation. The Volcker Rule on proprietary trading has been watered down. The Financial Stability Oversight Council has spent the last decade walking back their decision to designate insurers as systemically important and has largely been missing in action since. The Consumer Financial Protection Bureau was deemed by the Supreme Court to be unconstitutional, to the surprise of few. But probably the greatest cost of Dodd-Frank has been, well, the cost. Clocking in at some $69 billion, Dodd-Frank is a key culprit in any lack of competition in the banking space. And finally, the ugly. Perhaps the biggest issue with Dodd-Frank is not what it did, but what it left undone: systematic housing finance reform. The collapse of the housing market was such a key driver in the 2007 financial crisis, and wards of the state, Fannie Mae and Freddie Mac, pose more rather than less risk to the economy than ever. This would be worrying enough in good times, let alone bad. Happy birthday, Dodd-Frank.